Okay, chapter 17, investment and business brokerage. In this chapter, we're going to talk about uh, businesses. We're going to be talking about uh, ownership of commercial real estate. Um, and we're going to talk about a lot of investment lingo. So, we're going to explain the advantages and disadvantages of using in real estate to invest in, and describe the tax benefits of real estate investments and the effects of the New Jersey Uniform Commercial Code. Um, so, what are some of the advantages in investing in real estate? Well, some of the advantages are that you get a return on your investments. Okay, so the advantages of investing in real estate are to generate some sort of return on that investment. We're going to talk about leverage. Leverage is using borrowed money to do your investment. And you could do that in real estate because you use borrowed money. Usually, when you buy real estate, you get a loan, unless you're buying all cash. And then inflation, using inflation as a hedge. You know, property values, they fluctuate as the real estate market does. They go up and they go down. So that's what we call using inflation as a hedge, because as property values go up with the market, simply holding on to the property, you could generate a return. And some of the disadvantages is real estate's not highly liquid. What does that mean? It means you can't sell it quickly without taking some sort of a loss. You know, like stocks and bonds, they could go, their values can go up and they could go down right away in stocks and bonds. You know, you could have it go up and down and sell it several times throughout the day. But in real estate, usually if you buy real estate, you're not selling it the same day, the same week, or probably even the same month for a profit. So it's not liquidity. It doesn't have as much liquidity. Without Unless you make a major improvement or something, real estate's not going to go up in value, shoot up in value that quick. Um, it requires expert legal and tax advice and information, and there may be a high level of risk if you don't know what you're doing. So those are the highlights for what we just went over about return, leverage, and how real estate's not highly liquid over the short period of time. Usually you have to hold on to it long enough to rise in value, or you got to force some sort of a rise in value through doing improvements and such. Usually you're not going to sell it quickly and not take a loss. So here are some ways you can invest in real estate and yield a return. By holding on to the property long enough that it appreciates in value, using the inflation as a hedge. Uh, you do nothing to the property, just holding on to it. Simply, inflation drives prices up. So it's generally expected that real estate values are going to go up over time. So when you sell it at a future date, it should be profitable. Income property can be held for producing rental income as well as for profit on its eventual sale. Cash flow, that's spendable income after your expenses. You want that cash flowing, right? But that's what cash flow is. It's spendable income after expenses. And pyramiding through refinancing, that's when you keep refinancing your property, draining your equity out, and then using that equity to buy more real estate. And you keep doing that over and over again. You could find yourself owning a lot of real estate. However, it is all highly mortgaged. So that could be a little risky to do as well. Equity is the difference between the current market value and how much you owe on the property still. And that can be generated in several ways through inflation, just the property values going up, through forced improvements, increasing the value of the property, or through periodic payments paying down the debt. That increases the equity as well. So here we go, page 328. Cash flow, that's spendable income. That's the object of owning income property, is to generate that cash flow through your rentals. So there are some tax breaks for home sellers. For residential real estate, we know that um, if you live in the house for at least 2 years before you sell it, 2 out of the last 5 years before you sell it, um, single tax filers are entitled to a $250,000 capital gains tax exclusion from the sale of their primary residence. Married couples who file their taxes together jointly, they're entitled to a $500,000 capital gains tax exclusion from both state and federal income tax. So if the owner lives in the property for at least 2 out of the last 5 years, they can sell it and not pay any taxes up to that 250,000 or half a million in profit on the sale of their primary residence. If the owner lived in the home for less than 2 years before selling, the IRS does allow deductions if there are certain hardships. Now, their examples of hardships are job loss or transfer. You're forced to sell early because of those things. Health reasons, death, divorce, or multiple births. And they could still give you that capital gains tax exclusion for those reasons. Okay. And you could use these deductions as often as every 2 years. As long as you live in the property, it's your primary residence, right? Sellers may pay income taxes on the profit from sale of an investment property, but not for a primary residence. Okay. So this chapter, we're going to start talking now about ways you could save when selling those investment properties too. Something called a 1031 exchange. Let's just do these highlights and then we'll go to the next slide and I'll explain them on the next slide with my notes. Do you already have these highlighted by chance? Or I should be holding off for the highlights. You good? Or you already have them? Okay. So here's my slide on the same things that were highlighted pretty much, but I just put it in my own words, explain it a little clearer. So you may want to snap a pic of this, the tax benefits of a 1031 exchange. So sellers have to pay income taxes on the profit of the sale of any investment, right? This is an investment property. So they may realize a capital gain, which is basically taxable income. Now we know residential property, you could get that 250 or $500,000 exemptions from paying any capital gains tax on your primary residence. But for investment properties, that's a different story. You don't get that, and you need to pay taxes on it. So through the 1031 exchange, sometimes they refer to this as a tax deferred exchange. You can defer paying taxes on the property, the sale of an investment property, if you reinvest that money in purchasing another similar like kind investment. In this case, another investment property. Now, you need to have a team together, a real estate agent that's aware of how these work, have a tax attorney, because somebody should be, or have an attorney and a CPA. Somebody should be in communication with the IRS, filing the paperwork with the IRS, letting them know that you're going to be doing a 1031 exchange. And then there's certain timelines that need to be followed. These strict timelines must be followed. Otherwise, you'll lose the benefit of being able to defer paying taxes on this on the sale of this property. So In a 1031 exchange, you wouldn't have to pay income taxes until you eventually cash out and realize the gain when you sell the property. But if you sell the property, reinvest that money in another investment property, you don't have to pay the taxes until you sell that property and realize the gain. You follow? So strict timelines must be followed to qualify for the tax deferment. And I'm going to go over how that works. So you should have a tax attorney or CPA that communicates with the IRS. You must notify the IRS that we're going to be doing a tax deferred exchange, a 1031 exchange, at the time of the sale of the current investment property that the owner has. Then the IRS would give the investor 45 days to locate another investment property that they wanted to purchase. Okay, and then they have 180 days, a total of 180 days to close on that purchase. So they must identify that property within 45 days and close on it within 180 days. It's not 45 days plus 180 days, it's 180 days total. But you need to identify the new replacement property within 45 days, notify the IRS that you have, and then close on that property within 180 days. Okay. 180 days total. Okay. Boot is when the replacement property costs less than the sole investment property. The difference in value is known as boot. That's your capital gain. Boot is loot, and all loot is taxable. That's a way you could look at it, I guess. But that's the capital gain that you're going to have to pay taxes on. Okay. So capital gain is taxable profit on this investment. The basis, this is investment lingo. It's like your base price that you would pay for an investment before you put in any additional monies to do improvements. It's your initial cost to purchase the investment. That's what the basis is. An adjusted basis is the base price plus any additional money you put into that investment afterwards factored in. That would be the adjusted basis. So if you buy a property, that's your base price, whatever it costs to buy it. And then if you put money in it for improvements, you add that to your purchase price, and that is your adjusted basis. So that's all the money that you have in it. And when you sell the property eventually, you only pay income taxes on the profit after you subtract all the money that you put into it. Okay. You don't pay taxes on the portion of the money that you already put into it. So you got to subtract that from the sale price. So here, this explains it a little bit here. What can I do with this? Okay, so we have our 1031 exchange here. Hmm. How do I do this? Okay, just give me 1 second. I'm going to make an adjustment here. And just making a little animation here. That's it. Okay, let's see if this works. So, boot, when doing a 1031 exchange and the replacement property costs less than the sold investment property, the difference is boots, and boot is loot, and all loot is taxable. So, the basis, let's just say the basis is $300,000. That's the initial cost. Plus your improvements of $100,000. You're all in, your adjusted basis is $400,000 in that property. Now, let's just say you sell that property for $600,000. Ooh, that didn't work out right. Uh, I'm just trying to work this out. So it's, I guess there's no way to do that. All right, so you got your adjusted basis of $400,000, and the selling price is 600,000. You have a if the property appreciates and sells for $600,000, then there's a $200,000 capital gain. If you were to reinvest it all into another income property, you would defer paying any of that tax in a 1031 exchange. If you reinvested the entire 600,000, that $200,000 capital gain. Otherwise, if you just put it in your pocket, you'd pay taxes on the 200,000 of profit. But if you sell a property for 600,000, you buy another replacement property for 500,000, you're only reinvesting 100,000. The other 100,000 you're putting in your pocket. That difference in value is known as boot. And boot is loot, and all loot is taxable. That's your taxable capital gain. All right. Oh, there we go. Okay. This is fine. And then this. Sorry, trying to fix this thing. Screwed it up. Okay, good enough. That should work now. Good enough. Boom, boom, boom. Yeah, okay, good enough. All right, so depreciation. What is depreciation? Depreciation is a loss of value due to any cause or any condition, right? We've learned about that. However, here we're talking about investment properties and investments. And when we talk about depreciation, we're talking about an accounting concept where you're deducting the cost of an investment and any improvements on that investment for taxation purposes. Um, and assets costs depreciate. The IRS has a life expectancy of those assets, and you need to depreciate that asset. You can't just write it all off, its entire cost off on your taxes in 1 year. It has to be depreciated over a period of time. So large assets, like if you have a business and you buy a van, or you got a plumber, they buy a new van. Um, that can't be written all off in one shot. That's an asset they need to write off, I think, over 7 years. That's the life expectancy of it. So they have to depreciate its cost over 7 years. They could write it off on their taxes, and not all at once. Same thing with real estate. For residential real estate, the lifespan, what they do is they call it the economic lifespan of the improvement. You can only depreciate the improvement to the land, not to the land itself. So the building, the structure. So for residential real estate, that's 27.5 years, 27 and a half years. And for commercial real estate, it's 39 years. So keep in mind, this depreciation, it is not a reflection of the actual value of the property. It's only an accounting concept for writing off the cost of this investment off of your taxes against any income you have. So property's value cannot be depreciated all at once. Once again, it has to be done over the asset's economic lifespan, whatever the IRS defines as its life expectancy. And land, like I said, cannot be depreciated because land does not depreciate. Um, so you could only depreciate the improvement of that asset. Once again, residential real estate, 27.5 years, commercial real estate, 39 years. Now, you don't even need to memorize that. I don't think that they're going to give you a question based on that. If they do give you a question with about this stuff, they'll probably give you the number of years, and it'll be a math problem like this. Okay. So here's what you're highlighting about depreciation here. Okay. And right next to the title, if you haven't, economic lifespan of an improvement, because that's probably the wording that they're going to use on the exam question. And when they use that wording, they're talking about this problem right here. When they talk about the economic lifespan of improvement. So this is the kind of question you get. If a property's estimated value is $500,000 and the land's estimated at 150,000, how much would be depreciated over 3 years if the asset has an economic lifespan of 27.5 years? Well, right off the bat, we know we're talking about residential real estate, right? Because commercial real estate, it's 39 years. So how do we solve this problem? We take $500,000, the total property value. Then we subtract the land value because land cannot be depreciated. And we're left with a $350,000 improvement value that we could write off on our taxes. However, you can't do that all at once. It's got to be over a period of 27.5 years. So the question is asking how much would be depreciated over 3 years. So we'd have to first divide that by 27.5 years to figure out how much can be depreciated each year. and we get 12,727 and 27 cents. Now times that by 3 for the 3 years, and there's our answer, 38,181.82. Okay. If you want to snap a picture of that, how to calculate the math on that, it's not that difficult, but it's you got to remember this part here, that you have to deduct the value of the land. If you don't do that, you're not going to get it right. It's a simple math problem, but can be easily gotten wrong if you forget it. All right. The federal tax law limits the deductibility of losses from rental property. Your first $25,000 of loss can be used to offset income from any source. Investors must actively participate in the management of the property. We call that sweat equity, like you're doing your own rent collection and dealing with the tenants yourself and cutting the grass and stuff like that. That's sweat equity. And has taxable income of less than $200,000 before the deduction's made. So a tax credit is a direct deduction in taxes due rather than deduction from income tax before the tax is computed. I'll have on another slide a little better explanation of this, showing you a side-by-side math comparison between a tax credit and a tax deduction. Now, tax credits can be issued for several things. Let's see, tax credits, is far greater value. Investors in older buildings, renovations, and low-income housing projects could use tax credits to offset taxes up to $25,000 of income. Tax credits have been provided for taxpayers to renovate historic properties. However, those historic properties have to be registered with the National Register of Historic Landmarks. And then the allowable credit is 20% of the money spent on the renovation. Okay. Now, this is only good for non-residential historic properties. If you use it for a house you're living in, there's a credit of 10% of rehabilitation cost for non-historic buildings placed in service before 1936. Non-historic buildings must be non-residential properties. The law also provides tax credits ranging from 4 to 9% each year over a 10-year period for expenditures on new construction and renovations of low-income housing. We don't need to memorize all that. That's why none of that is highlighted, okay? But here, tax credit is a direct reduction in taxes due rather than calculating a deduction from income tax before the tax is computed. Okay, here's the breakdown. Taxpayers who renovate historic properties, non-historic buildings put in service before 1936, they are eligible to tax credits. And sometimes politicians will offer a tax credit as a stimulus, like they did when the real estate market was crashing. So in 2008, 2009, and 2010, they offered a tax credit for people to rush out and buy a house of $7,500 in mid-2008 to mid-2009. When that tax credit went away, the real estate market continued to drop like a brick again. So they said, oh, politicians and all their arrogance said, we know what happened there. We didn't throw enough money at the problem. So this time they offered an $11,000 tax credit to incentivize people to rush out and buy a home when the real estate market was crashing, to try to stabilize the market. I think they just wanted to stretch it out a bit, and they didn't care if they pulled people into financial hardship. Because the rule that they had was if you rushed out to buy a house and you took advantage of these tax credits, you had to live in the house for at least 3 years before you sold it. Otherwise, you had to pay it all back immediately to the IRS. Now, this isn't money that they gave you. This is just a tax credit. But you'd have to pay that money back to the IRS if you sell the property and you didn't live in it for 3 years. So when the real estate, when they people rushed out and bought properties, the real estate markets kind of leveled out a little bit. You know, they kind of leveled out a bit, but they were still sinking. Now, when that tax credit went away, the market started crashing again, continued because this was just nothing more than just stretching out the time. And politicians, they can't correct a market correction by getting masses of people to go out and buy real estate. All that's going to do is when the market is crashing, all that's going to do is flatten the curve temporarily, and then it'll continue correcting itself afterwards. And that's what happened. So the politicians just managed to pull more people into financial hardship when they ended up selling the properties because they bought the properties, and then when they continued dropping, if they think that 7,500 or 11,000 wasn't enough to overcome it, they're thinking, oh, we got to be near the bottom now, and then it's going to flatten out. That should be enough, but it wasn't. So they pulled a lot of people into financial hardships that were not. They did their short sales to get out, and then the IRS comes knocking on the door. Give us our 7,500 or $11,000. We want it all now today, please. Otherwise, you're going to pay late fees and penalties. That's the IRS. So that was not a good thing for those folks. Now, that movie I told you about, The Big Short, this talked about that financial crisis, but it didn't talk about what happened when after the markets crashed and the politicians were offering these tax credits. That could be a movie all in itself, how they destroyed people's credit after that. All right, now let's see how the tax credit versus a tax deduction comparison is. So let's just say that you have $100,000 in income a year, and you get a $15,000 tax deduction versus a $15,000 tax credit. So how does that work? Well, if you have $100,000 in income and you have a tax deduction of $15,000, you subtract that from your income, and then your remaining income was $85,000. That is what is taxable now. So now you tax it by your 15% tax bracket. Let's just say you're in a 15% tax bracket. And now you owe $12,750 in income taxes for that year. Now let's move over to see if you got a tax credit. Tax credits, if you have $100,000 in income, you calculate your taxes, and that's $15,000 in taxes. And then you apply the credit to it. And that's what you owe. So which one's more valuable, a tax deduction or a tax credit? See, tax deductions deduct before tax is computed. Tax credit, it's after, and you can see it makes a big difference, right? When you apply that deduction, makes a big difference. Okay, so a land contract, also known as an installment sales contract. We learned about this in chapter 11. It's a type of seller financing where you make payments in installments and wait for the deed. The owner doesn't give you the deed until you paid off the full amount owed or some other amount that you agreed upon. That's a land contract or installment sales contract. There's complex tax rules, so you should have a CPA involved, certified public accountant. And it's figured on the investor's marginal tax rate. Okay, I'm not a tax guy, so I'm not going to go into the details of this. It's beyond our scope. Okay, but that's an installment sales. They're referring to the land contracts. Okay, business organizations, a syndicate. So these are not legally formed business entities. They're formed to carry out business project. When the project is done, the business entity is done. Syndicate is a joining together of two or more people to carry out that business project. It's not a legally formed entity, meaning that you don't go down to the county and register the business, and then carry on a syndicate like you do for an LLC or a corporation. Um, Joint venture is a little bit different. It's also not a legally formed business entity, but it's a joining together of two or more groups instead of two or more people, two or more groups to carry out a business project. When the project's done, the joint venture is done. Now, real estate investment syndicate is a business venture in which a group of people pool their resources to own or develop a particular piece of real estate. Kind of like the little old ladies sitting around the table playing cards and deciding that they're going to pool their funds together for all their retirement plans to buy an investment property that they could then all reap the rewards of. Okay. So that's a real estate investment syndicate. Okay. So real estate in some instances can be considered a security. So when you seek money from investors to invest in a real estate project that you're going to own and not them, and you're just offering them a percentage of the profit to be investors in your project, this is a security. And you can do this, but you need to have somebody with the type of licensing to deal in securities to work with you on this. Uh, the property needs to be registered as a security. They need to put together a prospectus where you don't just tell people what the possible upside is. You also got to tell them what the possible risks are involved in investing in this project. Okay. Um, and this could be classified as a security. You could get into trouble, especially if investors are not familiar with real estate as an investment and then they lose money. Special licensing is required to deal in securities. And because it's real estate, you need someone with both a real estate license and a securities license. The investment must be registered with the FTC, Federal Trade Commission, the SEC, the Securities and Exchange Commission, and the state of New Jersey, because we have blue sky laws that regulate these things. Now, such offerings must have a prospectus prepared warning those investors of the possible risks involved, not just the possible upsides from the profits. We learned in earlier chapters about general partners versus limited partnerships. General partnerships, all of the co-owners in the business work in the day-to-day business. All the investor owners in the business work in the business. So they share equally in the profits and the losses, and they can be held liable for any additional debts that the business takes on. All general members are partners, are general partners that work in the day-to-day business activities. Whereas in a limited partnership, there's always at least one general partner who works in the business that's an owner. And they take responsibility for any additional debts that business takes on. All the other investors involved are they're like silent partners who are limited in their liability to the extent of their initial investment in the business. It's like they buy stock in the business, but they don't work in the day-to-day activities of the business. It's not their responsibility to run the business. It's the general partners. And if the business takes on any additional debts, taking out loans and such, only the general partner can be held liable for paying them back, not the limited partners. A REIT is a real estate investment trust, and they get the same tax benefits as mutual fund investors. That's all you need to know for exams as far as that goes. But a REIT must have at least 100 investors, and at least 75% of that trust income comes from real estate as the investment field. So you'll probably get a question on that on exam. Who do REIT investors get the same tax advantages as? mutual fund investors. Okay, do you need to have a real estate license to sell a business? The answer is no. You could sell a business without a real estate license. What if it's a web design business? There's no real estate involved. Do I need to have a real estate license to sell that? No. So you don't need to have a real estate license to sell a business unless there's real estate that's involved in the sale. And then even with that, we don't prepare the contracts because attorneys prepare contracts on commercial properties for sale or lease, right? So a lease or real estate sales contracts, those need to be transferred, negotiated, and prepared by attorneys. Besides title to the real estate or a present lease that may be involved, an attorney would be needed to prepare the sale and lease contract and the contracts to transfer other business assets like trade fixtures, stock and inventory, business names, customer lists, the goodwill or special rights like copyrights, patents, franchises, licenses, lottery machines, etc. Okay. So an attorney would handle all that. All we do as real estate agents is we market the business for sale. Okay. But there's something that we need to watch out for when we do that. Okay. I'll tell you, we're going to get into that in a second. I thought it was coming up on this slide. So when you buy a business, to finance the purchase of a business, you need to have cash or you get a personal loan, business loan. A lot of money is needed to put down to purchase commercial real estate, usually 20 to 25% as a minimum. The business purchase requires cash or personal loans to purchase. Okay, so need to know for exams. Okay, when selling a business, we as real estate agents, we can market it for sale and find a buyer for that business. However, before we market a property or a business for sale, we need to get the owner of that business to disclose any unpaid stock or inventory that they have, or machinery or tools that are not fully paid off yet that they've been financing, to the prospective buyers, that when they tell them, hey, stock and inventory and all these tools are included in the sale of the business, they got to disclose that it's not fully paid off yet. And they need to inform those creditors that gave them those tools or stock or inventory that the business is for sale. This is to prevent fraud, where a seller may say, hey, everything's included in the sale, and then take off and not pay off those things. And then the buyer's on the hook now for that. Well, that's fraud. Okay. And if we help them market the business, we help them perpetrate that fraud and commit that crime. So I would suggest you get a real estate, I would suggest you have an attorney involved in selling these businesses. Make sure the attorney takes care of that stuff. So that's called the Bulk Transfer Act. It's designed to protect.
What kind of question can come from this bulk transfers?
The question is going to be about the Bulk Transfer Act. First of all, just understand this, and whatever kind of question that they give you, you'll be able to figure it out. Look, the Bulk Transfer Act is designed to protect the seller's creditors from the fraud perpetrated by the business owner who sells the business, including equipment and stock, and then disappears, leaving those creditors unpaid. So this law is in place to protect who then?
I'm sorry, sellers.
The seller's creditors. The seller's creditors. That's who it's there to protect. Now, it also protects the buyers, but as a side effect, kind of like homeowners insurance that's required when you buy a home, you're required to get homeowners insurance, right?
Yeah.
But who does homeowners insurance protect? Who
So,
requires you to get it? When you buy a home, who requires you to get the homeowners insurance before you could close on a sale? It's the lender because they want their collateral insured in case there's a fire or flood or something. They want their collateral insured because that real estate is the collateral. So they want that homeowners insurance that names them as the payee in the event that there is a disaster. They get paid. Okay. Um, in the same regard, the Bulk Transfer Act protects the buyer in that way. Um, it's more there to protect the seller's creditors, but it also protects the buyers in the business, um, but kind of as a side effect, just like homeowners insurance protects the home buyer, but kind of as a side effect. It's really there to protect the creditors, just like the Bulk Transfer Act. So here, the Bulk Transfer Act is designed to protect the business seller's creditors in the sale of a business. It also protects the buyers, but as a side effect, because they should be informed that all the inventory and machinery or tools, the chattel of the trade, have not yet been paid for in full, and therefore can chase after the seller's personal assets to get reimbursed. So the Bulk Transfer Act is designed to protect the interests of the buyer as well as those of the seller's creditors in the sale of the business. But it's mainly the seller's creditors it protects. The buyer's protected as a side effect. Okay. And if you help somebody sell their business, it is a criminal, they've committed a crime. It's a criminal offense. And if you help them commit that crime, well, you help them commit a crime. So real estate's not covered under the Bulk Transfer Act, just the business personal property. So real estate brokers and salespeople are never allowed to draw up contracts for any commercial transactions. All we do is market and advertise it, and we get a buyer. Attorneys put the deal together. Okay. Here's another slide that talks about it. Uh, what you need to know. Okay. The Bulk Transfer Act is part of the UCC, the Uniform Commercial Code, not the Uniform Construction Code. We learned about two UCCs, the Uniform Construction Code, which is the state's minimum standard for construction in real estate. And the UCC here is the Uniform Commercial Code. Now, the Bulk Transfer Act is Section 6 of the Uniform Commercial Code, which regulates the sale of businesses. Okay. So it protects the business seller's creditors from the seller selling the business and its inventory and equipment, saying it's included in the sale, but it has not yet been paid for in full. Then the seller leaves their creditors unpaid. That's fraud. So if you help them perpetrate that fraud, you help them commit a crime. So the Bulk Transfer Act regulates the transfer of chattel when selling a business. It prevents fraud when the business is sold. It requires the business seller to make a list of all outstanding debts to creditors and supply that list to potential buyers. So we should tell them to do that and have an attorney involved so that they do as well. And notify the creditors that the business is for sale. The real estate licensees must ensure that these disclosures are made to avoid assisting the sellers in committing that crime. So who does the Bulk Transfer Act protect? The seller's creditors, but it also protects the buyers and their creditors, but as a side effect. Non-compliance is a criminal offense. So if an agent helps a seller perpetrate the fraud in the sale, they can be held liable for helping commit that crime. So real estate brokers may not draw up contracts for commercial properties or business sales or transfers. That's practicing law without a license. So only an attorney can handle those things. So this is actually a pretty good slide. It has everything you need to know about the UCC and the Bulk Transfer Act. So, did you get a chance to snap a pic of the slide? Or you good? Okay. And that concludes this chapter. Okay. So I told you this chapter wasn't that long. We could get through it pretty fairly quick. Let's do the key terms to review. Cost plus improvements minus depreciation.
Adjusted basis.
One is A, correct. An increase in value.
Appreciation.
Two is B, appreciation. Initial cost of the real estate.
Basis.
The basis. Three is C. You're starting to see a little pattern here. The book manufacturer forgot to do something. They forgot
Yeah.
to they forgot to
Okay.
scramble the answers
Oh,
up. They're all in
okay.
order. A document transferring ownership of personal property.
Bill of sale.
A bill of sale. Four is D. Extra money or property received by one party in an exchange.
Boot is a
Boot.
loot.
Five is E. That's right. Boot is loot, and all loot is taxable.
Taxable.
Like the pirate's booty, right? All right. Well, here are my notes to the book manufacturer. Gotta let them know that this was not scrambled up. You gotta submit to them a bunch of stuff. And this was one of those things. Come on, come on. These, I got all these notes over here. Where are my notes for the book manufacturer? I don't know what I did with them. Well, all right. So, where did we leave off? Which one? Sorry.
Boot. E. F.
Five is E. Okay. Law regulating the sale and financing of business personal property.
Bulk Transfer Act.
Six is F. Bulk Transfer Act.
Oh,
Taxable
it's
profit.
all in the same order.
Yeah, that's what I said. The
Oh,
book
okay.
manufacturer forgot to scramble it. That's why I was looking to make a note
Mm,
so I could send
okay.
that to the book manufacturer with corrections in the book. I was going to let them know that this this is the only key terms in the book that's like that,
Okay.
though. Taxable profit on the difference between the adjusted basis and the net selling price uh,
Of an asset.
of an asset.
Capital gain.
That's a capital gain. Seven is G. Money left from rental income after expenses are paid.
Cash flow.
Cash flow. Eight is H. Now, this is a bad definition here.
Mm,
Yearly bookkeeping charge for part of initial cost. Nine is I, depreciation. Uh, Tax deferred mutual transfers of income property.
exchange.
10 is J, exchange. And real estate held for rental income.
Income property.
Income property. All right. So now the other one is scrambled up. It's not all together like this.
Yeah.
Sorry, I got all these notes all over my desk here. Where are my notes for the book manufacturer? I got to let them know about this one. Okay, there we
That's
go. I see them. There we go. This is chapter 17, right? Page 336.
and
I have a list of a lot of corrections for this book. All right. So key terms two, law regulating the transfer of business personal property.
I use Uniform Commercial Code.
10 is A, Uniform Commercial Code, the UCC. Uh, Refinancing property to buy more.
Pyramiding.
Um, 4 is B, pyramiding. Okay. Uh, Direct deduction from income taxes due.
Tax credit.
9 is C. Joining together of two or more people to carry out a business project.
Syndicate.
8 is D. Group pooling resources to buy real estate.
A re, uh, uh, Real estate investment syndicate.
Syndicate. 5 is E, correct. Rate at which the investor's top dollar is taxed.
Rated which top
The investor's top
and
dollar is taxed. That's the marginal tax rate. The marginal tax rate. 3 is F. Sale in which the seller receives purchase price over a period of years. And then they get the deed.
installment sale.
1 is G, the installment sale. Correct. Extensive use of borrowed money for purchases.
Leverage.
Leverage. 2 is H. Fund making real estate investments and selling shares.
REIT.
Yep, a real estate investment trust, the REIT. 6 is I. Cash flow plus income tax savings plus appreciation. These are all examples of
Return.
a
Return.
return. 7 is J. And that concludes chapter 17.